If a central bank reaches the point where every available move creates a different kind of damage, then the question is no longer whether policy is hawkish or dovish. The question is whether policy is still policy at all. That is where I believe we are. And that is the first thing I would tell you if you asked me what this latest Federal Reserve meeting actually means. Most people heard a hold. I heard a confession. Not a verbal confession, because central bankers are trained to avoid those. A structural confession, a confession made through the shape of the trap, a confession made through the range of choices that no longer exist, a confession made through the strange silence around the one thing gold has already started pricing, and the Fed still cannot afford to say in public. It is not trapped because it is incompetent. It is trapped because the arithmetic has finally become stronger than the language. That is the real story. And once you understand that, you stop listening to the rate decision the way amateurs do. You stop asking, did they cut? Did they hike? Did they pause? That is child-level analysis. You start asking the better question. What would the institution have done if it still had room? That is how serious investors study a trapped central bank. Not by what it says, by what it can no longer choose. I have watched central banks for enough years to know that their public power is always greatest, right before their actual room to maneuver gets most constrained. That is because institutions do not lose credibility all at once. They lose it in layers. First, the language grows more careful. Then the official explanations grow less satisfying. Then the euphemisms multiply. Then the market starts pricing the contradiction before the institution is willing to admit it. That is the phase I think we are in now. And gold, which for decades has functioned like a private lie detector attached to the monetary system, is already reacting to a condition the Fed has not publicly named. It is not reacting to one press conference. It is reacting to paralysis. I want to explain paralysis in a way that actually makes sense. Imagine a surgeon standing over a patient with 3 tools on the table. The first tool stops the bleeding but shuts down the lungs. The second keeps the lungs working but lets the bleeding continue. The third buys an hour of temporary relief while making the underlying wound worse tomorrow. That is not a doctor making free choices. That is a doctor rationing damage. That is what the Fed is doing. And when a central bank crosses from choosing policy to rationing damage, the market's relationship with money changes, not in theory, in behavior. That is why I do not think the rate hold is the headline. The hold is merely the visible shell. The real event is what the hold reveals. It reveals an institution that cannot cut, honestly, cannot hike safely, and cannot print openly without exposing the system it is trying to preserve. That is why I say the trap is complete. And it is also why I think we are moving from the calm phase of the gold bull market into the part that history later remembers as the real move. I know that sentence will sound dramatic to some people. So let me make it less dramatic and more precise. Gold tends to move in phases because the market does not understand monetary deterioration all at once. The first phase is quiet institutional positioning. The second is public recognition that the central bank has lost freedom. The third is the open monetization phase, when the institution can no longer hide what it is doing behind gentle language and alternative labels. The move most people remember usually happens in Phase 2 and Phase 3. The problem is that by the time Phase 3 is obvious, much of the easy asymmetry has already been taken by people who understood Phase 2 in time. That is where I think we are now, and the distinction matters because Phase 1 rewards patience. Phase 2 rewards preparedness. Phase 3 rewards only those who were already in the right place before the crowd finally arrived. I want to start with the trap itself, not the conclusion, the machinery. Because if you do not understand the machinery, then every gold forecast, every silver thesis, every warning about the dollar, every conversation about bonds just becomes another emotional story. You can either like or dislike. I am not interested in stories. I am interested in mechanisms. The first mechanism is what I call the oil collar. Oil above a psychologically important threshold is not just a commodity event. It is a policy collar. It tightens around every rate decision the Fed might want to make. If inflation were drifting down politely and energy were calm, the Fed could justify easier policy into a slowing economy. That would be the old playbook. But when oil is elevated enough to keep feeding cost pressure into transport, food, industrial inputs, and inflation expectations, then cuts stop looking like support and start looking like surrender. That is the collar. The Fed cannot claim victory over inflation, while an energy shock is still threatening to push the unfinished job right back into the bloodstream. This is what casual observers miss. They think inflation is one number. It is not. It is an environment, and an environment shaped by energy is much harder to negotiate with than an environment shaped by weak demand alone. That is why the oil shock matters far more than the average investor appreciates. It does not simply make consumers uncomfortable. It narrows the range of politically survivable monetary choices. The second mechanism is the slowdown noose. Here is the other side of the same trap. The economy is not strong enough to tolerate a textbook anti-inflation response without damage spilling elsewhere. Growth is weak enough, unemployment soft enough, manufacturing soft enough, and the consumer squeezed enough that a rate hike or even a stubbornly high plateau begins pressing on the whole structure through credit costs, refinancing pressure, and lost confidence. This is why I say the Fed cannot raise rates safely. Not because it would be impossible in a technical sense, because the cost would not remain technical. It would move through housing, through corporate debt, through consumer balance sheets, through private markets, through Treasury financing, and eventually through the political layer of the system itself. That is the noose. The Fed knows the economy is too brittle to absorb a traditional anti-inflation campaign without blowing stress into places the public still treats as separate. They are not separate. They are only separated by the delay with which pressure travels. The third mechanism is the Treasury choke. This is where the whole discussion stops being a normal macro debate and starts becoming a debt management problem disguised as monetary policy. If the United States had a modest debt load, the Fed would still have pain to manage, but it would have cleaner pain. That world is gone. The sovereign now sits beneath a refinancing burden so large that the cost of money is no longer just an economic variable. It is a fiscal event, when trillions have to be rolled in a higher rate world. Every quarter point stops being an abstract policy calibration and starts becoming an interest expense transfer from the future into the present that matters. Because the Fed no longer sets rates in a vacuum. It sets rates over a debt pile, and once policy lives over a debt pile, the debt pile starts voting in every meeting whether anyone says so or not. This is what most people still refuse to internalize. The state is no longer simply one actor in the economy. It is the largest refinancing client in the room. And the larger the client, the less theoretical the cost of discipline becomes. That is why I say the Fed cannot hike safely. It can say the words, the market can price the idea, but the second you run those rates through the refinancing machine, the system starts revealing where the true constraints lie. The fourth mechanism is what I call the balance sheet lie. This one matters because it tells you what kind of institution we are really dealing with. Now, a central bank that has taken large losses on its own balance sheet, then renamed those losses with accounting language designed to neutralize their political meaning, has already crossed an important internal line. It is no longer only managing the economy, it is managing perception of itself. That is not a trivial difference. An institution can survive large losses, but once it must also survive the public interpretation of those losses, it becomes more careful about words, more dependent on euphemism, and more tempted to separate what it is doing from what it is calling what it is doing. That is where the euphemisms start. That is where money creation acquires gentler names. That is where emergency support becomes reserve management, liquidity smoothing, technical operations, normal balance sheet function, or whatever phrase sounds sterile enough to keep the crowd from recognizing the old mechanism wearing new clothing. I have watched this too many times to be fooled by the language. When an institution changes the label while preserving the act, it is not clarifying. It is controlling reaction. And gold has always been better than the public at understanding the difference. Gold does not ask what they called it. Gold asks what they did. That is why I say gold hears what Powell will not say. The fifth mechanism is the succession fuse. This may be the least appreciated and most explosive element in the entire setup. A central bank can still retain some credibility under pressure if the market believes the next steward of the institution is meaningfully independent of the political demands pressing from outside. Take that away and everything speeds up. Not because the new chair is automatically reckless, because the market is forward-looking enough to understand what becomes thinkable once independence stops feeling unquestioned. A succession environment shaped by political pressure toward easier money changes how every current decision is interpreted. A hold no longer looks like calm conviction, it looks like borrowed time. A delay in cuts no longer looks like patience. It looks like a temporary resistance line ahead of a change in doctrine. That is the fuse. Even if policy has not yet shifted, the expected direction of political influence begins repricing assets before the formal shift occurs. The market is not naive. It knows how institutions are softened, not all at once. In sequence, pressure first, replacement later, doctrine last. Gold does not need the replacement to be complete to start pricing what the replacement means. That is what Phase 2 looks like. The sixth mechanism is the hidden liquidity drip. I want to be absolutely clear here because this is where many people lose the thread. Phase 2 does not begin when the central bank announces obvious money printing with a brass band and a confession booth. Phase 2 begins when the market concludes that more money creation is functionally inevitable and begins front, running that future before the language catches up. This is why the quiet purchases matter so much. This is why reserve management language matters. This is why technical buying, balance sheet adjustments, short-end support, hidden liquidity maintenance, all of it matters. These are not side stories. They are how the institution buys time. And buying time is exactly what trapped institutions do when they cannot yet solve the problem without worsening another problem. That is why I call it the hidden drip. It is not enough to overwhelm the room immediately. It is enough to reveal direction. It tells you what the institution will choose under enough pressure, even before it is politically ready to admit it. That is what gold is pricing, not a full flood yet. Direction of leakage. And once you know the direction of leakage, you know more than enough. Now I want to speak about phases more carefully, because this is the structure underneath the entire thesis. Phase 1 is the sovereign and institutional repositioning phase. This is the quiet buying stage. Central banks buy more gold than history would have led you to expect. Reserve managers reduce dollar concentration at the margins. Private actors with long memories and low need for headlines begin allocating toward metal. Not because the public is panicked, but because they can read where the policy logic is heading. Price rises, yes, but it rises in a way that still feels calm enough for the public to dismiss. That is Phase 1, a professional move, a positional move, a move designed not to announce itself too loudly, because the smart buyer wants size before consensus. Phase 2 begins when the market stops asking whether the central bank prefers one path and starts asking whether any clean path exists at all. That is the transition. Once the market understands that the Fed cannot cut without feeding inflation, cannot hike without stressing debt and growth, and cannot remain passive forever without a hidden liquidity response, eventually becoming a visible one. Then the buying behavior changes. It stops being only institutional. It starts becoming anticipatory and broader. Gold is no longer just strategic reserve diversification. It becomes the market's way of pricing coming monetary cowardice before official language grants permission to say so. That is Phase 2. And historically, Phase 2 is where returns stop being polite, because the move is no longer being powered only by patient institutions. It is being powered by realization. Realization is always faster than education. That is why Phase 2 moves so hard. The crowd does not need to understand the theory perfectly. It only needs to feel that the institution is cornered. Once that feeling becomes widespread enough, the repricing is violent. Then comes Phase 3. Phase 3 is where the euphemisms fail, where the balance sheet expands too visibly, where the purchases are too large to be called technical without insult, where inflation or currency weakness or both become obvious enough that even passive savers begin understanding that something is being taken from them slowly and deliberately through the unit itself. That is when silver usually stops being a footnote and starts behaving like silver. That is when miners stop looking like eccentric leveraged plays and start looking like cash machines attached to a repricing metal. That is when the broad public finally arrives, usually later than it thinks, and pays for the privilege of certainty with much worse entry. This is why I say Phase 2 is so important. Phase 1 is the warm-up, only in the sense that it conditions the market. Phase 2 is the moment the market recognizes the institution cannot restore the old equilibrium without walking directly into another disaster. That is the recognition window. And recognition windows close faster than accumulation windows. Now, I want to explain why this moment matters so much for gold, silver, miners, bonds, and every dollar asset at once. Because they are all expressions of the same problem seen from different angles. Gold is the reading on monetary freedom. The less freedom the central bank has, the higher gold tends to speak. Silver is gold with a nervous system and an industrial appetite. When the market starts seeing monetary stress as real and persistent, silver often lags just enough to create violent later catch-up as the public rushes into what it had ignored. That is because silver sits at the intersection of monetary response and industrial scarcity. It can feel clumsy in Phase 1 and then act outrageous in Phase 2 and Phase 3. That is part of its nature. Miners are simply operating leverage attached to the same thesis. A rising gold price does not add one for one to the economics of a miner. It can change the economics exponentially because large chunks of the cost base do not move as fast as the revenue line does. That is why mining equities often look lazy early and explosive later. The crowd hates them until it suddenly realizes the margin machine it ignored has become impossible to ignore. Bonds tell the same story in the opposite direction. A long-duration dollar promise becomes less attractive when the market starts suspecting that the institution managing the currency can no longer defend purchasing power without detonating other parts of the system. That is why long yields can misbehave in moments when the old safe haven script would have suggested a different response. A sovereign market under too much debt and too little monetary room stops being a simple shelter. It becomes a referendum on whether funding privilege still outranks arithmetic. That is not a referendum you want to sleep through. Every dollar asset inherits this logic, not because every dollar asset collapses together, because every dollar asset must now be evaluated under the same higher order question. What happens to you when the currency authority managing the base layer of the system has lost clean freedom of action? That is the question. A wonderful company can still be a poor investment if the discount rate, the currency regime, and the policy backdrop all turn against it. A cash position can still be psychologically comforting and economically weak if the unit itself is being slowly compromised. A long-duration fixed-income position can still look civilized and still behave like a sacrifice to a system trying to finance itself through inflation tolerance and hidden support. This is why I keep saying the Fed meeting is not the story. The story is the loss of maneuvering room. That is the thing gold is hearing. Now let me tell you what most investors will do wrong here. They will wait for the language to become obvious. They will wait for the first undeniable public cut into stubborn inflation, or the first unmistakable expansion of overt purchases, or the first explicit acknowledgement that growth is too weak, debt is too large, and inflation is too sticky for the old toolkit. That is what they will wait for. And by the time they get it, they will be buying Phase 3 prices with Phase 1 confidence. That is how people destroy asymmetry. They substitute comfort for timing. They pay a premium to avoid feeling foolish for a few months. This is one of the most expensive instincts in all investing. I have almost no sympathy for it because history punishes it so consistently. The right question is not whether the Fed has already announced surrender in words anybody could understand. The right question is whether the market now has enough evidence that surrender in some form is mathematically embedded in the future path. I think the answer is yes. That is why I say Phase 2 has already begun. Not because the crowd has arrived, because the structure is complete enough that the crowd's eventual arrival is only a matter of sequence, not theory. I want to say something else that matters. This is not only about getting bullish on gold, it is about getting honest about the dollar. A reserve currency does not need to collapse dramatically for savers to suffer. It only needs to underperform its old standard of trust, while the state and the central bank quietly rely more on dilution, softer repression, and gentler language to manage a burden that clean discipline can no longer carry politically. That is enough. Retirement accounts measured in dollars can grow nominally and still weaken in real terms. Bond allocations can look respectable and still leak purchasing power. Cash can feel safe and still be a patient's waiting room for erosion. That is why the central bank trap matters to ordinary people, not just gold bugs and macro tourists. A trapped Fed is not a trading anecdote. It is a signal about the future honesty of the unit in which most people's lives are denominated. That is the scale of the problem. Now let me bring this back to the three specific phases. Two triggers I think matter most. The refinancing trap is first, too much debt rolling at too high, a cost in a world where higher rates do not simply slow inflation, but threaten fiscal stability itself. The succession trap is second. A central bank facing political pressure through leadership transition is no longer being evaluated only on its models. It is being evaluated on how much independence the market believes is still intact. The private credit and private market strain is third. Every long period of cheap money builds structures that only work if refinancing remains easy and valuations remain flattered. When that turns, somebody must take the losses. And when the private system cannot absorb them quietly, the public monetary system gets drafted into the cleanup through one mechanism or another. These three triggers do not need to explode on the same day. They only need to point in the same direction. That direction is enough. Gold does not require a calendar invitation. It requires convergence. That is what it is seeing. Now I want to leave you with the only question that matters. What kind of investor are you going to be during a phase? To transition, the kind who waits for the press conference to say something explicit enough to feel safe, or the kind who understands that the silence itself has become the signal? Because that is where the edge lives. Not in perfect timing, not in certainty. In correctly reading when an institution has moved from steering the machine to managing the consequences of a machine it no longer fully controls. That is the threshold. That is the contract. I will not wait for the central bank to admit what the structure has already made plain. I will not confuse a held rate with a free institution. I will not ignore the oil collar, the debt choke, the balance sheet lie, the succession fuse, or the hidden liquidity drip. I will treat euphemism as information. I will understand that phase 2 begins before the crowd's language changes. I will respect gold as a reading on lost policy freedom rather than as a shiny opinion poll. And I will remember that the largest moves in monetary history usually begin while the public is still being told nothing important has changed. Something important changed, the freedom of the institution changed, and once that changes, the market starts moving toward the truth long before the podium does. That is why the investors who understand it now will not be making the same decisions as the investors who wait for phase 2 to become emotionally obvious after the market has already done most of the work.